Growth stocks or value stocks? This is one of the biggest debates in investing, and for good reason. Choosing the right strategy can make a huge difference in your portfolio's performance. But how do you decide? Today, I'll break it all down: what these stocks are, their pros and cons, historical performance, and most importantly, which one you should pick. What are growth stocks? Let's start with growth stocks. These are shares of companies expected to grow their earnings or revenue faster than the market average. Think of tech giants like Amazon, Tesla, or NVIDIA. These companies reinvest their profits to fuel expansion, innovation, or market dominance. But here's the catch: growth stocks are often expensive. You'll notice they have high price-to-earnings (PE) ratios. Why? Because investors are betting on their future potential, not their current earnings. Take Tesla, for example. If you invested $1,000 in Tesla 5 years ago, it would be worth over $8,000 today. That's the kind of explosive potential growth stocks can offer. But high rewards often come with high risks. Key traits of growth stocks: high valuations, higher P/E and price-to-sales ratios. No dividends. Most growth companies reinvest earnings. Volatility. They can skyrocket or crash quickly, depending on market sentiment. What are value stocks? Now, let's talk about value stocks. These are the diamonds in the rough, companies trading for less than what they're really worth. Think Coca-Cola, Johnson & Johnson, or even big banks like JP Morgan Chase. Investors love value stocks because they're like buying $1 for 80 cents. These companies might not have flashy growth rates, but they're stable, often pay dividends, and are less volatile than growth stocks. For example, Coca-Cola has been a solid value stock for decades. It doesn't grow as fast as a tech company, but it consistently pays dividends and holds up well during market downturns. Key traits of value stocks: lower valuations, low P/E and price-to-book PB ratios. Dividends: many value stocks reward shareholders with consistent payouts. Stability: they tend to perform better during economic downturns. Pros and cons of each. Alright, let's compare the pros and cons of growth and value stocks side by side. Growth stocks pros: high potential for capital appreciation. Beneficial during economic booms. Industry leaders with strong innovation pipelines. Growth stocks cons: high volatility, often overvalued, increasing risk. No dividends, so you're relying purely on price growth. Value stocks pros: often undervalued, meaning less risk. Steady performance during bear markets. Dividends provide passive income. Value stocks cons: slower growth, may remain undervalued for a long time, can underperform in bull markets. Which performs better historically? Let's look at the numbers. Historically, value stocks have outperformed growth stocks over the long term. But there's a twist: this depends on the market cycle. In the 1990s, growth stocks, led by tech companies, outperformed. Then came the dot-com crash, and value stocks ruled the early 2000s. Fast forward to the 2010s, and we saw another growth boom, driven by companies like Apple and Amazon. The lesson? Growth stocks shine when the economy is expanding, while value stocks offer stability during recessions. How to choose: growth or value? So, which should you pick? It depends on 3 things: your goals, your risk tolerance, and the current market environment. Financial goals: if you're young and looking for aggressive growth, growth stocks might be your ticket. But if you're nearing retirement and need income, value stocks are a safer bet. Risk tolerance: can you handle volatility? If so, growth stocks might appeal to you. If not, value stocks will help you sleep better at night. Market conditions: pay attention to interest rates and economic trends. Growth stocks suffer when interest rates rise because future earnings get discounted more. Value stocks, on the other hand, thrive in uncertain times. Can you combine both? The good news is, you don't have to pick one over the other. Many successful investors combine growth and value stocks in their portfolios. For example, you might allocate 60% to growth and 40% to value, or vice versa, depending on your goals. Practical tips for investing: here are some practical tips to get started. Use stock screeners. Filter growth stocks by revenue growth rates or high P/E ratios. For value stocks, look for low P/E or P/B ratios. Diversify. Don't put all your eggs in one basket. Balance your portfolio across sectors and geographies. Stay consistent. Use dollar-cost averaging to invest regularly, regardless of market conditions. Rebalance annually. Review your portfolio at least once a year and adjust based on your goals. So, growth stocks or value stocks? The answer isn't one size fits all. It's about understanding your goals, the risks you're willing to take, and the market environment. Remember, the best portfolios often include a mix of both. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and share your thoughts in the comments below. And as always, happy investing!